Thank you. Roger, thank you very much. That was very nice. It's really nice to be here. We have nice town hall events like this ourselves where getting everybody, the leaders in the organization together to talk about what's going on is so very important. So thank you very much. I know that David can't be here today. David, I know you're on the phone. I'd like to thank David for the invitation to speak to you today. Now, of course, you know David as your former CEO. What you may not know is that David was moonlighting during his time as CEO. In addition to his many civic contributions, from 2010 to 2014, he served as the Chicago representative on the Federal Advisory Council. And since 2015, he's been a valued member of the Chicago Fed's Board of Directors. We ask a lot of our directors, and David takes his role very seriously. In our monetary policy work, we rely on his valuable insights on the economy and his penetrating questions, even if he occasionally makes some snarky comments in what he claims are a response to my own snarky remarks. So it's a very good working relationship. The Chicago Fed has also benefited from David's leadership, insights, and guidance. In his usual energetic fashion, David has served on each of our committees that our board has, so I'm very happy that David is going to be on our board for another 2 years. Now, obviously, it's nice to be here. This provides me with a forum to communicate my views about monetary policy. Clear communication is essential for the accountability and effectiveness of our policy decisions. But the occasion offers an additional opportunity. Your experiences and perspectives help me formulate my thinking about the economy and monetary policy. Our timely assessment of developments is critically informed by the observations of people directly involved in business, labor, and community development. Such insights are particularly important at times like today when there appear to be a number of tough-to-read crosscurrents in the economy. Therefore, I look forward with great interest to your questions and observations at the end of my remarks. The format here is I have about 18 to 20 minutes of prepared commentary, then we're going to have question and answer. I'd like to discuss my outlook for the economy, the risks around my forecast, and how these assessments shape my thinking on monetary policy. But of course, these are my own views and not necessarily the views of the Federal Reserve System or the Federal Open Market Committee. Now, January is a time when I get plenty of speaking invitations to talk about my economic outlook for the new year. Now, of course, just like my annual forecast that I won't overdo it on holiday desserts, my economic predictions for 2019 come with a healthy slice of humility. With all of the developments over the past few months, this is a particularly treacherous forecasting period. One could easily end up with egg on one's face before too long. Now, why is that? It's because even though the fundamentals for growth here in the U.S. are solid, there are many uncertainties and risks currently staring us in the face. There are many crosscurrents to work through when making a forecast today. Let me begin by laying out my main points. 2018 was a very strong year, with gross domestic product growth currently expected to come in at around 3%. This is about a percentage point above the long-run norm, or what economists call the economy's potential rate of growth. Solid fundamentals lead me and most other forecasters to expect another good year in 2019, with growth coming in somewhat above potential. That said, this forecast has output decelerating, with growth closer to 2%. So compared with 2018, this economy might not feel like it's doing as well. Nonetheless, this type of growth in 2019 would come with healthy gains in household and business spending, keep the unemployment rate low, and have wages rising at a decent clip. Beyond 2019, I see output slowing further towards its longer-run potential, which I currently see as around 1.75%. By the way, this is a quite modest pace for trend growth relative to historical standards. Over the period 1982 to 2007, when the economy was growing, we grew at 3.25%. So 1.75% is substantially slower. In some other good news, the concerns we've had about inflation being too low have dissipated. I expect inflation to be near 2% this year. If fundamentals stay strong, I expect inflation to rise a little higher in 2020 and 2021, though certainly not by enough to be inconsistent with our symmetric 2% inflation target. But clearly there are risks that surround my forecast. In particular, recent financial market developments and uncertainties regarding growth abroad, trade policy, and possible fiscal headwinds have accumulated to increase the downside risks. Now, there are upside risks as well. Further momentum in consumer and business spending could cause stronger growth, or pressure on productive resources could boost inflation faster than I currently expect. Any of these various crosscurrents could pull the economy in a different direction than my baseline expectations. So as we move forward in this fluid environment, I will be particularly attentive to factoring the incoming information into my assessment of the economy and the balance of risk to the outlook. And it is this outlook and risk assessment that will determine my views about the appropriate monetary policy we need to follow to achieve our dual mandate objectives of price stability and maximum employment. Now, we've made good progress towards our dual mandate goals in recent years. Let's now look back a bit at last year. 2018 was a strong year for the U.S. economy. With impetus from still accommodative monetary policy and expansionary fiscal policies, the pace of economic activity picked up noticeably. We'll get the first read for the year as a whole at the end of the month. Most forecasters are expecting it to come in around 3%. This is significantly above both what growth had averaged over the previous 8 years and the economy's long-run potential growth rate, which I estimate to be just a little below 2%. It's also better than what most forecasters were expecting at the beginning of last year. For example, back then I projected growth to be around 2.5%. So 2018 will turn out to be a nice change for me because over the past 10 years, I, along with most forecasters, had often been too optimistic about how the economy would perform. It's good, for once, to miss on the upside. With this growth, labor markets continued to strengthen. Last year, more than 2.6 million jobs were created, and the unemployment rate declined further, averaging 3.8% in the fourth quarter. This is noticeably below the 4.4% rate that most FOMC participants currently associate with full employment. And a wide array of other labor market indicators, such as the number of discouraged workers or those working part-time for economic reasons, also point to a healthy labor market. The vibrant labor market and corresponding increases in household income were key factors behind strong consumer spending. The 2017 personal income tax cuts also contributed. In addition, business investment was strong last year, boosted in part by a variety of changes to the tax code. In another nice change from previous years, the news on inflation also has been good. After underrunning our 2% target for almost a decade, underlying inflation has finally picked up and has been near our target since last March. So as I look back to the economy's performance in 2018, I'm encouraged with the progress towards our dual mandate goals. Now, as we enter 2019, the incoming data on economic activity generally continue to be strong. Witness the December jobs report. Moreover, the most recent reports from my business contacts support these data. If these were all you were looking at, you would have popped another bottle of champagne on New Year's Eve. But as we all know, a lot else has been going on over the last few months. First, there are a number of uncertainties on the international front. Foreign growth in 2018 slowed from a strong pace in 2017, and markets are wary of a further step down. There also is concern that events such as a disorderly Brexit could have important spillovers to U.S. financial markets. And there's a good deal of uncertainty over U.S. trade negotiations with China and other trading partners, and the prospects for larger tariffs that could impose significant costs on U.S. firms and consumers. Second, the U.S. fiscal policy picture is unclear. In addition to the near-term risk of a prolonged government shutdown, there are questions about the feasibility of shaping an appropriate fiscal policy response to any future downside shock. Third, financial markets have been, well, shall we say, busy. Investors seem to be concerned about these international and fiscal risks, the sustainability of corporate earnings growth in an environment with such risks, and the possibility of the Fed removing policy accommodation too aggressively. I've read many accounts of the Fed possibly making a policy mistake at this point. I appreciate the feedback. Since the beginning of October, stock prices have declined noticeably, equity market volatility has increased, corporate bond spreads, particularly for riskier firms, have widened, and the exchange value of the dollar has risen. Taken together, these amount to a tightening in financial conditions. The question is this: how much will these factors impinge on U.S. growth and employment prospects, and what then should be the proper response of monetary policy? My view is these are important risks to monitor carefully, and that it will be prudent to exercise cautious data dependence when setting policy. That said, a case can be made that the economy could continue to perform smartly in 2019 if appropriate economic policies are pursued. Let me explain. First of all, when looked at from a broader perspective, the current tightening in the overall level of financial market conditions may reflect a recalibration by investors as they recognize the economy is now likely decelerating toward a modest, longer-run trend rate of growth. For example, the drop in equity prices comes after almost 2 years of fairly steady increases. Indeed, some analysts had argued that stock market valuations had gotten ahead of a reasonable outlook for earnings, and the recent declines in equity prices have brought the S&P 500 price-to-forward earnings ratio back down to around its long-run historical average. Similarly, the recent increases in corporate bond spreads come from very low levels, and spreads currently are just a bit above their average over the past 5 years. And like equities, this change in risk pricing may be a recalibration reflecting market recognition that growth is decelerating toward a 1.75% trend. In addition, while capital markets have turned less hospitable, banks are still reporting easier terms on business loans, and commercial and industrial bank lending has been rising notably. So it is likely that most firms still have access to reasonably priced funding. On the household side, the recent declines in stock prices have reduced household wealth some, and home price gains have moderated. But overall, household balance sheets are still in good shape. Furthermore, consumer borrowing rates have not risen to the degree that corporate rates have. With regard to international issues, forecasters have become optimistic about rising foreign growth prospects last spring, and the recent growth downgrades may be more of a retracing of this prior optimism. Furthermore, even with the latest markdowns, projections are still for growth in the neighborhood of potential. Like I said, a case can be made for a reasonably good 2019 economic outcome. But I do not want to downplay the risk too much. This is where the egg on my face risk may be better referenced to as a gooey cream-filled pie in the face risk. Volatility could continue, and financial conditions could tighten further. Another question is how well will more fundamental valuation judgments anchor asset prices in the face of shorter-term momentum trading strategies. On the international front, some currently unforeseen shock could materialize and send foreign growth lower. Geopolitical uncertainty is relatively high, and other difficult international challenges could emerge. Or we could find that U.S. growth in 2018 was driven by stimulative fiscal actions and monetary accommodation, and less by underlying private sector strength than we previously thought. And we have to be attentive for heightened uncertainty and caution weighing on consumers and businesses' spending and investment decisions. Therefore, as the FOMC noted in its December policy statement, as we go forward, we will be in a data-dependent mode, which means we will continually monitor global and financial developments to assess their implications for the economic outlook and the stance of policy. Now, I haven't mentioned inflation much, but of course, inflation developments play an important role in my data-dependent monitoring and assessment of policy risks. Those of you who have heard me in the past know that I had been concerned about the prolonged undershooting of our inflation target over the past 10 years. However, with firmer inflation readings in the past year, the inflation outlook has improved. Looking ahead, I expect inflation to rise a bit further over the next few years. With unemployment below its long-run normal rate, we should see continuing pressure developing on productive resources in the economy, generating higher costs and higher prices. Indeed, we've already seen such pressures building over the past year. My business contacts almost uniformly report rising input costs and higher wages. In recent months, annualized wage gains have stepped up to about 3%. This is noticeably higher than the wage increases we experienced earlier in the expansion. Moreover, with strong demand for their products, more firms say they have been successful in passing higher costs on to their customers. So today, the pricing environment seems much different than it did over the past few years. My modal forecast is for inflation to edge up further and average a touch above 2% over the next 3 years. Now, you might ask if inflation above 2% is consistent with our 2% target. The short answer is yes. As the FOMC has stated, our target is symmetric. So inflation running slightly above 2% is consistent with the symmetry of the FOMC's goal, particularly given the prolonged undershooting we had over the previous 10 years. There also are two-sided risks to my inflation forecast. On the downside, I am mindful of how my optimism in previous years for inflation rising to our 2% target did not always bear fruit. One thing that I'm wary of now is that with the improvements in inflation in 2018 and reports about rising resources and cost pressures, I would have expected to see various proxies for inflation expectations move up more than they have. I've worried before that inflation expectations are anchored somewhat below our 2% objective. Recent developments in inflation expectations continue to give me pause. On the upside, we are running with historically tight labor markets that in some periods in the past have been associated with much greater inflationary pressures than we see today. If these older relationships from the 1970s and 1980s reassert themselves, then inflation could exceed our goal by more than I currently anticipate. Yet the long-running undershooting of our 2% inflation target, along with still low inflation expectations, tell me that a modest period of inflation running near to even 2.5% would not be a big policy concern. So let me conclude with my outlook for policy. If the downside risks dissipate and the fundamentals continue to be strong, I expect that eventually the federal funds rate will rise a touch above its neutral level, say up to a range between 3 and 3.25%. This range is higher than the 2 to 3/4% long-run neutral level in the median forecast of the Federal Open Market Committee's summary of economic projections. Now that's eventually increases. What about the timing? Because inflation's not showing any meaningful sign of heading above 2% in a way that would be inconsistent with our symmetric inflation objective, I feel we have good capacity to wait and carefully take stock of the incoming data and other developments. If they warrant meaningful adjustments to my modal outlook or the balance of risk to the economy, then I could change my views on the appropriate path of policy accordingly. I think developments in the first half of 2019 will be very important for making this assessment of our future monetary policy actions. Hopefully, the economic data will be more like the strong December employment report, and financial market volatility will settle down. But whatever transpires, we will need to be mindful of carefully weighing the various crosscurrents and discerning the more fundamental changes in the economic and financial environment in either direction. To finish where I started, as we go forward, informal, qualitative economic intelligence and conversations with groups such as yours will be an important input to my evaluation of economic and financial developments. Real-world perspectives and experiences will help us develop the appropriate context in which to interpret the data and forecast from our statistical models. I see the other direction in our communications as being just as important. As my colleagues and I reassess the outlook, the balance of risks, and the appropriate path of policy, it is incumbent on us to effectively communicate how our assessments and policy views bring us closer to achieving our dual mandate goals. The answers may not be as definitive as many would prefer, but that reflects the difficult nature of policymaking in an environment full of various economic crosscurrents like the ones we face today. Thanks very much for your attention, and I look forward to answering questions. All right, so I think the format is they're roving microphones and some. That means somebody will be in charge. Well, all right, however you want to.
Hi. Whoa, that was loud, sorry. You made reference to the fact that price to forward earnings multiples are around long-term average now, but that's for the market as a whole, and financials seem to be getting hit harder, and some analysts have estimated that financials are actually pricing in about a 50% chance of recession in the next year. So I'd love to hear your thoughts on why you think financials investors are more pessimistic than the market as a whole.
Well, that's a good question. So, the commentary that I made was more based upon the implications for the overall economy. And so as you sort of look at valuations and adjustments there, I think that it continues to be in line with a pretty good economy growing, decelerating. Decelerating is always a challenge for most anybody, really, because you get accustomed to a certain growth rate. Now you're stepping down to something. And trend growth rate is far more modest, 1.75%. So one kind of question I always have is, do people really appreciate how moderate 1.75% growth is? And stronger growth usually solves a multitude of issues. I think in terms of financials, it's likely the case that they're even more forward-looking than most economic actors who are thinking about the decisions, certainly than consumers. And so, they're weighing risk to their own investment decisions and where their downside costs can be. Those can be somewhat different than the economic costs or the timing. But that's part of what we're looking at in terms of our financial markets, our interest rate spreads, long-term interest rates and things like that. Are they reflecting a change in risk premia, which might be reflecting potential downstepping of the economy, or is it just nervousness and we're going to have to see how it resolves? So we'll have to see how it plays out.
Hi, good morning. Thanks for being here. In your comments, you alluded to the downward trend we've seen in potential U.S. GDP growth. And I'm guessing one of the factors you would say is behind that is also the slowing trend we've seen in productivity growth. Are you worried that this low trend toward lower potential GDP will make the U.S. economy more cyclical going forward? And what are some of the factors you think are behind the slower productivity growth we've seen?
So the step down in trend growth over some period of time, like I say, from 1982 to about 2007, when the economy was growing, that is not in recession, our average growth rate was 3.25%. Now, there's some arithmetic involved in that. You can just sort of, as an identity, break down output growth as the input in the growth in the input in labor, everybody working, and then what everybody working produces, and that's the labor productivity part that you're talking about. So both of those are really, really important. And if you look at the 80s were a time where we had growth of 3% sustainably over a period of time. Productivity growth was really very weak. That was a 20-year period from 75 to 95 that's referred to as the slowdown in productivity. And there are a whole bunch of reasons for that, and actually there's a whole bunch of question marks about that as well. What made growth so strong was the labor force growth. The labor force growth was enormous. Baby boomers continuing to come in to the job market in increasing numbers. Female labor force participation over a long period of time continuing to increase and add to the overall labor input, and factors such as that. Now we're facing a downward labor force participation rate trend as people are aging, retiring. Their attachment to the labor force at all of those years of age is weaker. Female labor force participation has run its course, and so it's no longer adding to that, so the downward trend is really there. I would say the labor input slowdown is a much bigger factor in the trend growth rate than productivity. Productivity is we're estimating it to come in 75 to 95 was a weak point for growth. 95 to 2005 was a high water mark for growth. 95 to 2000 was digital machinery hits the factory floor and offices, and that type of capital embodied productivity increased a lot. 2000 to 2005 was business improvement processes taking advantage of all of the additional computing that we had and not really cleaning up low-hanging fruit of inefficiencies in the previous 5 years that were so good. And so that was a very strong period, and now we're going to come in somewhere in between that. And a lot of it comes down to technology can improve. There are a lot of gee whiz applications and things that we can do, but businesses have to find a way to put that into their operating environment. That's the part that really drives productivity. And it takes longer, and it's really hard to predict when it'll take place.
Over to your far right.
Hi, thank you for all your insights. I'm just curious, kind of bring it closer to home. So given the current macroeconomic conditions and your predictions, what's one piece of advice that you would give or one thought you would have for a business to be successful this year?
Wow, well, 2018 was good, so maybe continue doing what you've been doing. I think that everybody's got to be mindful of what their business line is and where their strengths are. I think the consumer's been a big strong point in the economy in 2018. I think a large part of that is the employment prospects have been increasing, even without wages growing very strongly. They have been increasing. There's enormous return to anybody with higher skills who are paid more, and so that's it. So any businesses involved in that, obviously, those are key places to maintain your focus. But I think this is clearly a time where you want to make sure that you're doing your operations as efficiently as you can. I know that that's what business people do, right? It's always the bottom line and wringing out inefficiencies and things like that. To the extent that everybody could grow top line revenue better, that would be fantastic for the economy. So much of the benefits that we've seen over the last many years have really been at the bottom line, and that's related to the productivity question as well as, focusing on productivity and continued strength would be good. But, I don't get too involved in that because businesses, by and large, do a very good job of what they're doing. I'm trying to figure out whether or not there's a change in the environment or there are impediments or headwinds or tailwinds. And we've had a tailwind for the last 2 years, and we're kind of leveling off, and monetary policy is readjusted to something much closer to neutral. And like I sort of said this in the speech, this is where we kind of find out. So we've been saying growth has been strong, and that's because the economy's strong. Or has it been because policy's been helping a lot? As we take back some of that to a more neutral level, we're going to find out just how strong everybody is.
We have another one over to your right here.
Good morning.
Morning.
There seems to be a lot of recent debate about the language that the FOMC uses in its guidance, and this debate between more straightforward language versus more subtle or nuance, and with pundits, analysts, everyone digesting literally every single word that comes out of the FOMC. As a member of that, I'd love to hear your perspective on, providing, is a trend towards more straightforward guidance and more straightforward language versus more kind of subtle or nuance to the guidance?
Yeah, it's an interesting question. So, there's sort of a few different dimensions to that. One is sort of we put out this statement after the meeting. And I've been with the bank for going on 28 years, I guess, since 1991. In 1994, the FOMC started something really, really innovative. They announced the decision that they made at the most recent meeting. Before that, they never said what they did. They just said, the meeting is over. And they took some actions in the markets, and then the market commentary had to tell you, the Fed just tightened policy. So we started announcing what the action was in 1994. We increased the short-term interest rate. And we've been innovating, and we've been making these statements, and now we describe the committee. First paragraph is sort of like the economy continues to grow nicely, strengthen the consumer and business. Second paragraph is, with this environment, we kind of think the issues are this for the economy. Third paragraph's more, here's what we did. We increased the target range, and there's a little bit of, and we're looking at this. We judge that we're gonna need to do this, or we expect, judge, that's a nuance. I'm not real good on all of these fine points on the wording myself, so I think straight talk is good. I was marveling one time when I read something about, it was during the 2016 presidential campaign, could have been any campaign, and somebody did a linguistic evaluation of the reading level of the FOMC statement. I think it came in at sort of like, I think it came in at like first year graduate level reading. And I remember saying to somebody higher up than me, that seems a little harsh, you know. To which the person replied, I think it's about right. Then they said, oh, but the candidates debate 8th grade reading level. And, you know, at some level, if you're going to have a communication with a large number of people, you kind of make things more plain spoken and whatnot. So it's a tension. I think being able to indicate what we're really doing. I think at some points it's a lot easier than other points. You know, when the funds rate's at 0 and we know the economy's doing better and we know we need to get the funds rate up towards something more neutral, which 2.5, 2 3/4, 3.5, I don't know, but it's way north of where we are. That's easy. As we get closer and the uncertainty around that becomes more first order for do we need to do more or can we wait? Is inflation going to take off? We have to be mindful of what the risks are and make judgments, and that's where it gets tricky. So I think it's somewhat nuanced, but we need to be as plain spoken as we can, and we need to talk more. And sometimes people don't like it when we talk more, right? Because then you explain what you're thinking, and what I'm thinking is different than somebody else. So that's the nature of our process.
Next question is to your left.
Hi, I'm sort of interested more in what the role is of the Federal Reserve Bank related to the other countries in the world. How does compliance rules in other countries, how does the economy of other countries impact what you do and what the impact is to the U.S. economy? Yeah, so the Federal Reserve is large and slightly complicated institution. We are part federal government, part private corporation, actually. This is really the thing that usually surprises people. I said at the beginning, David Nelms is one of our directors. We have a board of directors. We're a private corporation incorporated by Congress. Okay, so, and we answer also, we're overseen by the Board of Governors in Washington, and they're a federal agency that has some degree of independence. And so you've got 7 governors at full strength in Washington overseeing matters. They do more policy. We have bank supervision responsibilities that Congress assigned to us in a variety of capacities for overseeing bank holding companies, state member banks, if they're a member of the Federal Reserve System, and some other things. If they're designated as systemically important, we might have a role there too. So bank supervision is one. The policy regulatory aspect takes place in Washington, but we work at the reserve banks. We've got 12 reserve banks around the country. Chicago is one, but we've got San Francisco, Boston, New York. We've got 12 of them. And we act on behalf of the board to do bank supervision. So we have bank examiners come out looking at consumer compliance and all of those types of issues. The OCC can be doing aspects of that too, so it depends on the charter. We also provide financial services to depository institutions, banks that want to connect up to send funds by Fedwire. We run the network in Chicago, the Access Network, so that they can get there and make sure that everything's secure, and ACH and things like that. So we're involved in that, and we work closely together. In terms of the international aspects there, the monetary policy making, financial stability issues, and also the bank supervision issues. Various people in the Federal Reserve will work with the Bank of International Settlements, other foreign central banks, collaborate, share information is a lot of it. And we're always paying attention to how the global economy is behaving because it impacts how the U.S. economy is behaving. We need to know about that in order to set monetary policy appropriately.
We have another question to your left.
Thank you again for speaking today, and thanks also for the important role that you provide for the Fed as it provides service to the economy in America. It's much appreciated. I wanted to turn to Pennsylvania Avenue for a second. After last night, it appears that the White House and Congress are both kind of digging in, and I wonder if you could expand on your previous comment about the potential risks around a prolonged government shutdown? And then on the flip side, can you also tell us a little bit about the economic impact of spending well over $5 billion for this security process?
Yeah, so, lots of things take place in Washington, and for the most part, it doesn't have a large impact on the economy got to be careful about that. Federal government's very large, and they can do an enormous fiscal policy, takes many different forms, right? So they just passed corporate tax reform, they cut personal income taxes, they changed deductions and all kinds of things, and that's projected, I think at this point by the Congressional Budget Office, to increase the level of debt by $2 trillion over the next 10 years. It doesn't take place in any one year, so it has a smaller effect, but this is something that has implications for financing, availability of funds. As the federal government wants to use more of those funds in order to fund the debt, then does that mean that there's less for private corporations, other people to finance that? So we need to understand that. The issues now, today, that you're talking about are shorter term. We've gone through government shutdowns in the past. Typically, they haven't been very long. This one is coming up on perhaps being the longest, and still, but it's measured in weeks, not months, certainly not years. This is where you find out that certain activities the government performs, people really care about, and they care about them sooner rather than later. So we'll have to see how that plays out. The actual effect on the large economy usually is relatively small, but on the other hand, as you would know well in your business line, consumers' access to tax refunds that they have been expecting, counting on at this time of year is fundamental for their planning. Government workers who can't make a rent payment or a mortgage payment obviously, have an effect on things like that. So we'll have to see, how that plays out. But by and large, these things usually are relatively small in terms of the imprint on the economy. What many times as I think about different risk scenarios for the economy, global environment or financial factors, and I run them through some kind of standard economic model. And the first pass through is, there's a shock of this sort and financial markets reprice somewhat. What's that do to the economy? And you look through it and you kind of go, it might have an imprint, maybe 0.2 on growth, not a lot or something. And then you kind of go, I don't like that answer. I think it's a bigger risk. And then you add on to that, well, then consumers get risk averse. They start hunkering down. Businesses start planning to do less. Well, now all of a sudden you magnify these effects. And so the real issue, I think, is always, if it's contained to just the elements that we're talking about, $5 billion, that's a big amount of money, but it's relative to a multi-trillion-dollar economy, it's not so large. But if it takes on a larger significance in folks' minds and into their planning for the economy, then it becomes something far more meaningful.
Right here in the middle.
Thank you for being here today.
Thank you.
As you take a data-dependent approach to forecasting and to setting policy, do you tend to think that the tax changes from 2017 were more of a sugar high or can have a sustained growth, into the future economically?
Yeah, so certainly most of the economic analysis that goes into putting a forecast together determines that there was a fiscal stimulus that showed up relatively quickly. I mean, not immediately, but like in the first year. And so most of our forecasts, for like 2018 were that growth was going to be about, 0.5 percentage point stronger than it would have been if that had not taken place. And maybe that takes place for a couple of years, and then it wanes. In part because the stimulus itself sort of wanes in the out years, but the other thing is the longer-term growth rate really is determined by this labor force input and productivity. Now, if the improved tax reform led to greater efficiencies that led to higher productivity and innovation, then that underlying growth could be higher, and that could have a more permanent effect. That's always speculative, incentives go in one direction and economic activity sometimes follows, sometimes it doesn't. So we're talking a big economy and other things can take place. And then on top of that, you've got the rest of the world, and the rest of the world is a little bit slower. So even if I thought that there was more stimulus from fiscal policy, then other things could be happening. But basically, we have estimated that it's about a 3-year effect on growth, so that by 2021 for sure, maybe 2020, we're back down to about trend growth. And that's assuming nothing untoward happens, which is the way all forecasts are. It's like, I'm not going to forecast that something bad or something tremendously good happens. It could, but I don't know that it will.
We have another question to your right.
Right.
Governor Evans, thank you for coming out here and describing really a balanced view of both the upside and the downsides of what your forecasts are. The question, or actually the request, is could you share with us some of the forward-looking indicators that you focus on that would drive you to a conclusion that we're heading down one path versus another? Thank you.
Yeah, I mean, we say we've begun to emphasize more the data dependence of our policy. I mean, what's a little bit funny about that is we're always data dependent. It's just that sometimes we're further from where we think we're clearly headed, so it's obvious how that's going to happen. We're always looking at the data. The kind of data that always gets your attention are the labor market, the employment data. So last Friday's December employment report that was like 312,000 jobs created. We are at the point where in a mature economic expansion with no additional stimulus, the long run employment growth monthly is much more likely to be 100,000 just because the incoming labor, people retiring, you net that out, it's much more likely to be even 60,000 to 100, 120,000. But 300 continues to be very large and outsized. So any change in the employment climate would be material. The consumer's been very strong. What are the fundamentals that continue with a strong consumer? Obviously, employment prospects are one. Financing conditions are another. People who are looking to buy a home, obviously mortgage rates, when they go up, that puts that as a challenge. Now, that's also part of the monetary policy transmission mechanism. When I say that policy is headed towards a more neutral place, mortgage rates are going to go up too. If the economy is strong, then it's going to be associated with a level of housing activity which should be consistent with that trend growth. So anything that gives me a better idea of how we're doing relative to that trend sustainable level is going to be very important. Obviously, a lot of uncertainties with financial markets and the international situation. So there's always a lot to look at.
Hi, Charlie. As a former Fed worker myself and as a Michigan grad, I have to say I remember you seeming to favor the Michigan T-shirts when you were at the gym, so go blue.
Okay.
But question is, in your role as the 7G president, how much does the local economy, the 7G economy, play into your policymaking decisions?
Yeah.
And how does that affect your, advocacy or policy decisions?
Yeah, that's a really good question because, as I say, there are 12 reserve banks spread around the country, and the location for the banks was determined in 1913, 1914 when the Federal Reserve System was established. And so, given the economic development of the country at that time, most of the banks are, in the Eastern time zone. There's only one bank on the West Coast, San Francisco. And the San Francisco Fed has responsibility for the West Coast, Hawaii and Alaska and a bunch of the mountain states and Arizona and that type of thing. And so, and then Cleveland is the state of Ohio and a little bit of Kentucky and West Virginia. We've got 5 states here in the Chicago district, not the entire state, but the better parts of Illinois, Indiana, Michigan, Wisconsin, and Iowa. So it would be very easy to sort of settle in and kind of think about, gee, my economic district tells me that things are going well, or, oh, things aren't going well in my district. Maybe we need more accommodation in my district. That's not the way monetary policy
works or should work. It's got to be a national monetary policy where we're setting financial conditions in order to promote maximum employment and price stability for the entire economy. It turns out it's okay, in my opinion, to have these banks with different footprints, and that San Francisco only gets to vote once every 3 years instead of I get to vote every other year with Cleveland. There's just some peculiarities when you think about how 12 presidents are going to fit into 5 voting slots every year. As long as we're looking at the national economy, it's perfectly fine. But I do talk to a lot of people in the Midwest, in our district, our directors, meetings like this, try to find out what's going on. And that helps inform whether or not something different is afoot. Normally, you add up all of the 12 presidents' economic reports and average them, and it kind of looks like the national economy. But sometimes you get a little more forward-leaning. Oh, it looks like this is a little more of a problem. The consumer here is telling me more. In the Midwest, we are overweighted in manufacturing relative to the national average. That's a good thing. It kind of has a forward-leaning tendency to it sometimes, and so that can be helpful. But it's that economic intelligence that we really bring to the table, which is almost like a double check on all the national data as we put it together. So in terms of that magic bullet economic indicator that I might want to be looking at to tell me how things are going, it's not any one, it's a collection and a judgment that comes with that.
We have another question to your left.
Hi, thank you for being here and also sharing your insights. I have 2 questions. One of them is, since we had the last recession, and it's been so long, and I was wondering if you can share what you think why the reason is, and what would be, like why is it been so long, and what are the key factors that are keeping us having another recession, and also what's the in the near future, do you see we're gonna facing some recession risk? So that's just one question. I'm gonna ask my second question, which is unrelated, where you just mentioned that the Fed is a private organization. Where does the Fed get its funding? Is it public money or is it more of a private?
Right. Okay. So, right. So, where do we get our funding? So, as I mentioned, we're part of the overall Federal Reserve System. So we've got the governors and the Board of Governors in Washington, federal agency. You've got the 12 reserve banks spread throughout the country. Now, we are a private corporation. We don't really have a business line, though, that generates a lot of revenue. As I did say, we do provide private financial services to depository institutions and some other folks. And our responsibility is we have to price things to recover costs. So you might think that we have a tremendous advantage financially in terms of cost of capital because we can print money in some regard, and so it ought to be pretty cheap. So we ought to be able to kill people in terms of pricing if we did it that way. So the Monetary Control Act of 1980 said that we can't give those things away like we used to, and we have to compete with the private sector, and we have to price things in a competitive fashion sometimes. Now, this, in my opinion, we're at a disadvantage because we have other institutions who view some of our products, they give it away as a loss leader, and we're not allowed to do that. We don't provide those other things. So where do we generate revenue? And in fact, if you go back to the early Federal Reserve System, you had peculiarities. When we increased interest rates, which could have a bad effect on the economy, we generated more income for the bank. And if you go back to the 1920s, I believe my predecessor made some pretty poor decisions in terms of increasing, monetary constraint to generate revenue when the economy wasn't doing so well. So that's a bad thing. So instead of doing it that way, we have a consolidated balance sheet. We have a balance sheet. We have assets. I don't know if you've been paying close attention, but we have a very large balance sheet through all of the asset purchasing that we did during the long, slow recovery. I'll get back to that on the first question, yeah. And so our balance sheet is about $4.5 trillion. And so even though some of those assets are pretty low interest rates, that's a lot of assets. And so we generate way more revenue than we spend, of course, because we're a small organization. Everything we don't spend goes back to the Treasury and the taxpayer at the end of the year. So to some extent, we reduce any deficits. We tend to remit more back to the Treasury by quite a lot. Let's see, why was the way you worded it, I might have worded it differently. So it's been a long time since the last recession. That's true. That was 2009 was the June, summer was the bottom of the downturn. So it's been quite some time, coming up on 10 years. It's been a very long recovery. It's been a very long expansion. Part of this is because it was a very slow recovery. We fell so far, and then there's a lot of research that shows that recessions that are caused by large financial contractions on top of any economic contraction lead to very slow recoveries, and this one was exactly like that. So we had a slow recovery. We continued to have a long ways to go before we got back to potential, and that sort of stretched things out. So slower but longer. Hopefully we had pretty good policies in place to also help the economy and consumers repair their balance sheets, and firms' balance sheets are very strong. And so I think we got to a point where fundamentals are pretty good.
Over to your left. This will be our final question.
Well, I hate to wrap it up with this one, but it's been reported by the Fed that a large percentage of Americans, they don't have $400 in a savings account, and I'm just curious as to what impact that may have on the economy, and also what the Fed may be doing about it.
That's an astounding observation. It's not that far from the observation that there's a large number of people that don't have banking accounts, that aren't really involved in the financial system in a strong way, but the amount of buffer savings is relatively low. I mean, here's another version of this, it seems to me. Some years ago, I said to my staff, for a variety of reasons, but I said, we should talk about, are people saving enough? Are people saving enough for retirement? That seems to be a big issue. You talk to anybody who's involved in retirement savings planning, they'll say, Americans don't save enough. Well, it could be true. I think it's true, but, if you kind of look at this, there's sort of two aspects to this, which is, first part is you really should eat tuna fish sandwiches for lunch every day. The idea being you should control your spending, not the avocado toast that's sometimes ridiculed by older people, and things like that. But save your money, and then invest it, and that type of thing for retirement. And then you should invest smartly. So I was saying, I'd like to give a speech on this about how people aren't saving enough. You look at, and then they came back with some very clever analysis, and you got to understand. Half the population doesn't have this problem in the way that you're thinking about it. Take somebody who's got median income. Median income for a family of four in the U.S. is $63,000. $63,000. People below $63,000, these are often people who have don't have $400, or they might not have the bank account or whatnot. And it's not that they're not saving enough for retirement. They're not earning enough. Their Social Security is actually going to be going to be their retirement, that part. And then people who are extremely wealthy, they're doing fine. It's really in sort of that middle, to 3/4, 80 percentile probably, that type of thing. But there's a whole variety of issues related to households and their savings behavior. And this gets intertwined uncomfortably with this fact that trend growth rates are currently slated to be 1 3/4% growth. And what's wage growth going to look like in that environment? It's going to be lower than the 3%. Then there's the inequality that comes from, in part, from people with different skills. And so if you have a skill, if you've acquired skills that are highly remunerated, that's good. And if you are more at risk of those jobs disappearing, then that's another aspect of it. So these are not monetary policy issues. The Fed is very interested about this, and to the extent that there's anything that I can do to help
explain, investigate this, but it's really a much larger public policy issue, and addressing inequality would be one aspect of that too. So thanks very much. I've really enjoyed it.